Now, the carbon markets, as the name implies, are markets that allow for the trading of impact assets, otherwise known as carbon credits. There are two types of markets at play here: the regulated markets and the voluntary markets, which deal in carbon offsets. Now, this brings us to a discussion on carbon credits, which naturally starts with the Paris Agreement of 2015. Having identified that greenhouse gases, most notably carbon, was what was responsible for climate change, international CO2 emissions goals were laid out for every single country, and these goals were ratified by everyone with the exception of 6 worldwide. Under these new regulations, there was a tremendous amount of pressure put on companies to reduce their carbon footprint, and they can do that either by offsetting their emissions with actions that have a net positive environmental impact, or by purchasing carbon credits or offsets. Basically, carbon credits turn greenhouse gas emissions into a commodity by giving it a price and allowing companies the option to purchase permission to emit the carbon that they need. Think of carbon credits like a permission slip to emit greenhouse gas. When a company buys a carbon credit, they're buying the right to emit 1 ton of carbon. Now, for the purpose of our discussion here, we want to focus on carbon offsets and the unregulated or voluntary carbon markets. Now, these offsets are created through actions which bring about a quantifiably positive impact on the environment. Now, the voluntary carbon market is a $1 trillion per year market that deals specifically with carbon offsets. Unlike the cap and trade program, these are created by doing things that have a net positive environmental impact, such as planting trees or saving forests from deforestation. But research into carbon offsets has revealed that only about 20% of the environmental impact needed to offset greenhouse gas emissions can come from these types of efforts. The remainder is going to have to come from technological solutions. Now, there are a couple of massive issues that exist in this market that have thus far been preventing a lot of liquidity from entering. Greenwashing, lack of provenance, and lack of transparency are major deterrents to this market maturing to its full potential. All of these are issues that DevvE can solve with ease. At the end of the day, a lot of this comes down to a system of trust, and for a market that's almost $1 trillion in size, any hint of untrustworthiness simply won't work. Now, here's the cool thing. Where DevvE and DevX are uniquely suited in this regard is that we allow companies to issue these carbon credits directly on-chain, and therefore there's a verifiable record of when and why the credit was created and whether or not it's been sold. This removes the middleman and opens up a brand new paradigm for the way that carbon credits and offsets are bought and sold. Let's face it, we all love doing good for the environment, but business owners are beholden to their bottom line. So when it comes to buying carbon offsets, they had better come with the expected environmental impact that they promise, or else companies simply aren't going to take that risk.